Hello guys, thanks for joining this video. Today we'll be discussing how to do acquisition arbitrage for the year of 2023. So one of the best strategies for low risk, high semi decent returns on your cash position in 2023 would be to buy companies that have been acquired or have announced that they are being acquired by larger companies. So what you can do is Google acquisitions um, for last year to this year, and you'll see that data from the website such as Benzinga tells you all of the companies that are being targeted and the acquiring companies. What I've done here is created basically a Google spreadsheet listing the ticker of the company that is acquired and also the price that it's currently traded at and the acquisition price. What you'll see here is the arbitrage return. So if it's an all cash deal, the target company would be paying the existing shareholders, let's say $81 per share for Coupa software, and the current price is $80.11. So you will be getting approximately 89 cents once the deal closes and finalizes. Now, a key thing to know about acquisition arbitrage is that most of these acquisitions take about 3 to 2 years to finalize. For the more generic companies that have smaller market caps and do not pose regulatory threat to the market, for example, it's not a monopoly buying the firm, then it would be much faster. It will take about 3 months to 6 months. What you see are examples here nowadays that ultimately are extended given regulatory concerns or just ultimate drama with the acquiring firm or the firm being bought out. So one scenario would be the Elon Musk buyout of Twitter. What you'll see here is generally Elon Musk tried to back out of the deal. During his acquisition phase, he announced that he would be acquiring it in on April 14th, 2022. And after he tried to back out, it took a little bit longer for it to be finalized, for the judge to rule that his letter of intent is binding, and ultimately on October 29th, he had to buy all the the shares within the company to take it private, and that became ultimately approximately $53 per share. And if you got in during April 14th, you probably bought in around $43 or $33 to $43 a share, depending on if you bought it when he bought 9.1% stake or when he bought it on April 14th. So you made a nice $10 return on, say, $30 to $40, which is anywhere from 33 to 25% arbitrage return over the course of about a year and a half. So from April to October 20. If you start from when he started buying it in January 2022, it would have taken you about a year to slightly less than a year to make a 22 to say 33% return, which is a decent return, and it's an arbitrage return in the sense that you're taking a little bit less risk, given that you'll be getting all cash deal to buy out your shares. Another example will be Microsoft buying Activision Blizzard Entertainment, and ultimately they initiated the letter of intent on January, and then it's still ongoing regulatory scrutiny by the UK government, and you will be seeing them make a decision by the end of this spring year in 2023. So that's about a year and a half until you will get your money for your shares. So right now Activision is trading at approximately $70 dollars. So if we just go, let's just go to the stock price. It's trading at $75, and the ultimate buyout price would be $90 something dollars, $95. Oh, 82. Yeah, $95. So if you want to make $20 over 75, your return on this investment would be 26%, right? So just 26%. And ultimately, what you'll see from here is you can make 26% off your money in 1.5 years. Now, is that a good deal? Well, if you got in January, then it's not a great deal, because your net return for a year and a half would be only 26%. But if you get in now, when the odds are that they will pass this deal in the UK for the regulatory scrutiny, you can make 26% in about maybe 4 months, and that's a decent return for 4 months of work. And if it doesn't get passed, the price will most likely drop. You are taking a slight risk, but other firms out in the ecosystem within the gaming sphere will note that Microsoft had made a firm offer at $95 a share. Maybe other firms that are less monopolistic in nature will make a similar offer in the future. So this is another way to make some money. Now, I've compiled a list of companies that are soon to be closing their acquisition. So the way you would do that is look at the acquiring companies and their announcement. You want to go for the earliest acquisition announcements that you can come up with that have not closed. And right now the first two that were the earliest to announce are Thoma Bravo and Maxar Technologies. So Maxar is a satellite company. They sell satellite images to Google for their Google Maps service. And then for Coupa, they sell software for expense reporting within small businesses as well as large businesses. So if you look, for example, you bought some food while you were working for your company, and you wanted to expense it to your company, you would keep that receipt and then put that in the Coupa software for you to be reimbursed, and then the company can expense that on their accounting books. So that's kind of what these companies do, and these are the first two that were announced that have not been closed yet, and they should be closing soon. So it's been stated that Maxar should be closing within this first quarter of 2023. So if you got in now, you're going to get bought out at $53 a share. You stand to make about $1.50 per share in cash, right? So if you make $1.50 in cash for per share, so if you put in 1,000, you buy 1,000 shares, which is $51,000, right? It's still a lot of money to put in, and then you will get, $1,300 or $1,500, which is kind of risk-free because the deal is pretty much set. There is no regulatory scrutiny because the ultimate buyer isn't monopolistic in nature, right? So this will be passed. So you can make an easy 2.8% within about, let's say Q1, within 4 months, you can make 2.8%, right? Treasuries are risk-free, right? You're getting it from the government, and they're paying about 4%, 4% to 5% treasuries, right? And now that's for a year. That's for 12 months that you have to wait to get 4%. Whereas for this one, you can wait 4 months, and you can get if you just do the math, times it by 3, 4 months, it's the equivalent of like a straightforward annual return of 8% without any CAGR, right? Without compounding it up period over period. So 8% versus 4% treasuries. This is decent. So you put your money here while the market is plateauing, right? Because ultimately the tech sector has already rallied. It's a bull trap currently, and you don't want it to sit in speculative companies such as Tesla and Facebook, where the future is looks bright, but it could be a bull trap where your money goes back down to levels in October of 2022. So you don't want to risk that. So better to just buy something that can get you a annualized rate of return of 8%, right? Now this is a bit lower, Coupa. It's also set to be completed regulatory scrutiny and testing from regulatory agencies such as the FTC. Basically, ultimately, they're going to say that this will be closed in mid 2023. So if you want to make money in 6 months, or maybe 4 to 8 months, let's try 1% return. You'll get about 90 cents for every share you buy. So you put in you put in $800, you put in $800, you will get about $600 to $700 in return. So that's ultimately how you should look at this. If you take a look at what this annualized return is, it's about 1% within 4 to 6 months, so 2. So it's really about 2%. So if you just do this multiplied by 2, it's an annualized return of about 2%. It's not that great, but it's sort of risk-free because this deal is going to go through. Thoma Bravo is a venture capitalist firm. They do private equity. There's no reason for the FTC to deny this merger. I mean this buyout and privatization of the company, given that it's not a company that already has a 80% market share within expense software. So these are two options that you can buy. Now you'll see that there's another list. The problem with these companies is that you'll have to wait a much longer period, thereby reducing your net annualized return, right? You'll have to wait 6 to 8 months in order for you to get your cash back out of the shares that you buy. So they're not great candidates. But if I were to look at these companies, ultimately, if you look at the latest acquisition target that was released in February of the 6th of February, this is a non-binding agreement so basically Pegasus Capital, private equity firm, wants to take Creative Realities private, and they're offering 83 cents per share. Currently they trade at 77 cents per share, which is a premium of 7%. And the issue with this is that it's basically a letter of intent, just so that they can take a look at their financial statements for the company being acquired. They'll do their due diligence, and if they like it, they'll make a binding agreement. So this is a risk because it's not binding. It's not an actual offer that the Creative Realities can sue them for. In the case of Twitter, Twitter could actually sue Elon Musk to actually go ahead and buy their shares for $53 a share, because it was a binding agreement, whereas this is a non-binding agreement. So I think these are the best options right now, Coupa and Maxar, for a quick return while you wait for the Fed to pivot, while you wait for Jerome Powell to ultimately give the go-ahead to reduce the federal funds rate. All right, thank you.